Welcome to ICAN Academy YouTube channel. If you are coming across my lecture today, don't forget to subscribe so that you don't miss my upcoming videos. Thanks for watching ICAN. In this lecture, I want to examine the treatment of assets acquired on hire purchase in capital allowance. This is my fourth video on capital allowance. Try to watch my first 3 videos for better understanding. So, hire purchase is a transaction in which the seller of an item parts with possession by transferring the asset to the buyer, who in return pay to the seller the amount known as the hire purchase price by way of an initial deposit plus a periodic installment over the hire period. I repeat, hire purchase transaction is a transaction in which the seller of an item parts with possession by transferring the asset to the buyer, who in return pay to the seller the amount known as the hire purchase price by way of initial deposit plus a periodic installment over the hire period. For capital allowance computation purpose, I want you to note the following. Note the following for capital allowance computation purpose. 1. Only the principal portion of the payment should be utilized. In the computation of capital allowance. So, interest element should be excluded. 2. The hire purchase interest should be treated as an allowable expenses for tax purpose. The hire purchase interest should be treated as an allowable expenses for tax purpose. The hire purchase interest should be treated as an allowable expenses for tax purpose. So you should take note of this. Steps for computing capital allowance when asset is acquired on hire purchase. Steps for computing capital allowance when asset is acquired on hire purchase. When an asset is acquired on hire purchase and you want to compute capital allowance, the following steps shall be followed. Number 1 is to calculate the hire purchase interest. Step number 1, calculate the hire purchase interest. I will still explain this in detail. Calculate the hire purchase interest. There are 3 methods of calculating hire purchase interest, which I will still explain in this video. Step 2, deduct the hire purchase interest calculated above from the installment to get the principal portion. Step 2, deduct the hire purchase interest calculated above from the installment in order to arrive at the principal portion or principal element or principal component. You deduct the higher purchase interest calculated in step 1 above from the installment, meaning that the installment usually contain two variables, the higher purchase interest and the principal portion. So when you subtract the higher purchase interest from the installment, then you get the principal portion. Remember, I've told you that only the principal portion, if you look at the note 1, I've told you that only the principal portion of the payment should be utilized in the computation of capital allowance. So that is what we are trying to do in step 2. We want to arrive at the principal portion. Step 3, identify the basis period for capital allowance purposes. Identify the basis period for capital allowance purposes. Identify the basis period for capital allowance purposes. That is the step 3. So if you have watched my earlier videos on the topic, then you will understand this better. Step 4, align the deposit of the asset and the capital portion of the installment. If I say capital portion, or if I use the word principal portion or capital portion, I'm still referring to the same thing. So you align the deposit of the asset and the capital portion of the installment with the basis period. Align the deposit and the principal, which is capital portion. Let me use the word capital or principal, whichever one you call it. Capital portion of the installments. Align the deposit and the capital portion of the installments with the basis period. Align the deposit and capital portion. I've told you capital portion, principal portion. I'm still saying the same thing. Align them with the basis period. Then the step 5 is to compute the capital allowance for relevant years of assessment. Compute the capital allowances for the relevant years of assessment. Compute the capital allowances for the relevant years of assessment. These are the steps you will need to follow in computing the capital allowance where assets are acquired or hire purchase. I want to explain how to calculate the hire purchase interest. Calculation of hire purchase interest. There are 3 methods of calculating hire purchase interest. The first method is straight line method. Straight line method. Under this method, the hire purchase interest will be deemed to have accrued evenly over the hire purchase period. So if the hire purchase interest accrued evenly, then that means you are going to apportion the hire purchase interest equally over the hire purchase period. So under the straight line method, hire purchase interest will be apportioned equally over the hire purchase period. Same amount will be charged every year. So same amount will accrue to each of the periods. So that is under straight line method. To compute the higher purchase interest, remember deposit, the deposit of the assets plus the installments. So depending on the number of installments, if you have 4 installments, that means you are going to have 4 times annual installments. If installment is payable annually, annual installment. And it is possible the installment may be payable monthly, depending on the question. If you add the installments to the deposit, you get the higher purchase price. Higher purchase price. Then, from the higher purchase price, you less the cash price of the asset. Less cash price. If you subtract the cash price from the higher purchase price, then you get the higher purchase interest. Higher purchase interest. This is straight line method. The higher purchase interest you get here, you now apportion it equally. Remember, you have 4 installments based on my illustration. I've told you the number of installments may vary. It depends on the question. The number of installments must be stated in the question. So that means a higher purchase interest included in each of the installments under straight line method. Higher purchase interest included in each of the installments. You take the higher purchase interest you have here. Higher purchase interest divided by number of installments. Number of installments. So if you divide the higher purchase interest you've arrived at here by the number of installments, this will give you the higher purchase interest per installment. So the higher purchase interest you get here, you now subtract it from the installment. So in order to get the principal element. That means the principal element now, principal element of the installment or principal portion, that will be equal to the installment minus the higher purchase interest included in that installment. Principal element or principal portion of the installment now will be the amount of that installment minus the higher purchase interest included in that installment, what you have arrived at here. This method is easier to use. And if question is silent under exam condition, I will recommend the straight line method. You should use the straight line method. If examiner is silent, if you are not being told to you whether to use the sum of the digits method or the arbitrary method, go ahead and use the straight line method. Method number 2, sum of the digits method. Sum of the digits method. Under this method, the higher purchase interest is apportioned or in a reversing pattern by using the sum of the year's digits. Higher purchase interest is apportioned in a reversing pattern by using the sum of the year's digits. So that means to use this method, the first thing you have to calculate the higher purchase interest calculated earlier. You have to calculate just same method what I've done under straight line method. So you may have deposit, then plus installments, so which is 4 times installment, just like what I've done in the first case. That is under straight line method. So you get the higher purchase interest. Then you subtract the cash price. Then you get the higher purchase. This is higher purchase price. Higher purchase price. So you subtract cash price, you get higher purchase interest. Higher purchase interest. So you now apportion the higher purchase interest. Let me say apportionment of higher purchase interest. Apportionment of HP interest. Apportionment of higher purchase interest. So you have year, 4 years, 1, 2, 3, 4. Based on what I've done earlier. You now reverse the digits. So now let me now have the digits. You reverse it. Starting from year 4, year 3, year 2, year 1. So sum up the digits now. 4 plus 3, that will be 7. 7 plus 2, that will be 9 plus 1, that will be 10. The sum of the digits is 10. So the higher purchase interest you have got in here, you now apportion it. So this year now, apportionment of higher purchase interest. Apportionment of HP interest. So you have 4 over 10 times HP interest. HP interest you have gotten under this method. So the amount you get for year 1. Then year 2, it will be 3 over 10 times HP interest. So you get that for this year 2. Year 3 will be 2 over 10 times HP interest. That will give you for the year 3. Year 4 will be 1 over 10 times HP interest. So that will be the interest. If you sum up the interest here, it will still be the same with what you've got in here. So this is the apportionment of higher purchase interest. Then you now calculate the principal element of each of the installments. I've given you the model earlier that the principal portion or principal element. I said the principal portion or principal element equals to the installment minus the HP interest. That is the higher purchase interest you've apportioned. Then you subtract it from each of the installments. That means year 1, you take year 1 installment minus the higher purchase interest for year 1. For year 2 now, you take year 2 installment minus higher purchase interest for year 2. In year 3, you take the year 3 installment minus interest for year 3. Same for year 4. That is sum of the digits method. The third method, this is method 2. The third method is actuarial method. Actuarial method. Under this method, the higher purchase interest is calculated on the outstanding cash portion. To compute the higher purchase interest under this method, you have year, you have opening balance, Then you have the higher purchase interest, Then you have the closing balance. Opening balance, higher purchase interest, you have installments, then you have closing balance, This is the format for computing the higher purchase interest using the actuarial method. So for year 1, you have the opening balance, which will be the cash price minus deposit. That will be the opening balance for year 1. Cash price minus deposit, if any. That will give you the opening balance. Then the higher purchase interest, you'll be given the rate to use in the question. If you are to use the actuarial method, the rate to use will be provided in your question. So you apply that rate on the opening balance here, then you get the higher purchase interest. Then the installments will be given. This is year 1 interest. Opening balance plus higher purchase interest minus installments, that will give you the closing balance. The closing balance for year 1 will be the opening balance for year 2. So you have that closing balance as the opening balance here. Then you also apply that rate, same rate on this opening balance for year 2. You get the higher purchase interest. Then the installment will be provided opening balance plus higher purchase interest minus installment. That will also give you the closing balance for year 2. Then you get to year 3. The closing balance in year 3 will be the opening balance. Closing balance for year 2 will be the opening balance for year 3. You also apply same rate on this. Then you get the higher purchase interest. Then the installment for year 3, opening balance plus higher purchase interest minus installment. That will give you the closing balance. Then you have year 4. So the closing balance here will be the opening balance for year 4. Then you apply the same rate on the opening balance. You get the higher purchase interest. Then the installment. The closing balance will be nil if it is payable over 4 years. So this is the format for computing the higher purchase interest under the actuarial method. Example, on 1st September 2024, Idiaraba Limited entered into a higher purchase agreement with Idiarere Limited. 10 generators were acquired on higher purchase by Idiaraba Limited with 2 million naira paid as initial deposit on that date. This was followed by 24 equal monthly installments of 200,000 naira commencing from November 30, 2024. The cash price of the 10 generator was 5.6 million naira. Idiaraba Limited usually prepare its account to June 30 every year. Required. Compute the capital allowance for relevant years of assessment. Ignore investment allowance. This question is obtained from ICAN study test. Now let's have the solution. Solution. So I've told you that the first thing is to calculate the higher purchase interest included in each of the installments. Calculation of higher purchase interest. Calculation of higher purchase interest. To calculate higher purchase interest, so we use the deposit of the asset. How much is the deposit? Now, back to the question. 10 generators were acquired on higher purchase by Idiaraba Limited with 2 million paid as initial deposit. So, initial deposit is 2 million. So, we have the deposit of 2 million. Back to the question. This was followed by 24 equal monthly installments. Remember, this is a monthly installment, not an annual installment, of 200,000 naira. So now let's have the installments. Installments, 24 equal monthly installments of 200,000. So we have 24 times 200,000. That gives us 4.8 million. 4.8 million. If you add 2 million to that, you have 6.8 million naira. This 6.8 million represents the higher purchase price. Higher purchase price is 6.8 million. Back to the question. The cash price of the 10 generators was 5.6 million. Cash price is 5.6 million. 5.6 million. If you subtract 5.6 million from 6.8 million, then you'll be left with 1.2 million. 1.2 million. This 1.2 million represents the higher purchase interest. I've told you where the examiner is silent as to the method of spreading the higher purchase interest, that the straight line method is preferable. So, to use straight line method now, higher purchase interest included in each of the installments. It will be 1.2 million naira divided by the number of installments. And we have 24 equal monthly installments divided by 24. So the higher purchase interest per installment, so 1.2 million divided by 24, you have 50,000 naira. The higher purchase interest included in each of the installments is 50,000 naira. So meaning that the principal element of the installments will be, so the principal element, that is the principal portion of the installments now, that will be, the installment is 200,000. Each installment of 200,000 minus the higher purchase interest per installment of 50,000. So the principal element will be 150,000 naira. Every installment contains the principal element of 150,000 naira. The next thing is to determine the basis period for capital allowance purpose and the qualifying capital expenditure. That is second step. If this is step 1. Step 2, basis period for capital allowance and the qualifying capital expenditure. So, back to the question. You were told that Idiaraba Limited usually prepare its account to June 30 every year. The accounting year end of Idiaraba Limited is 30th of June. This is not a new business. So it's an existing business. For an existing business, you make use of the preceding year basis. So remember, you were told on 1st of September 2024, Idiaraba Limited entered into a hire purchase agreement with Idiaraba Limited. 1st of September 2024. The 2025 year of assessment, you are going to have the 2024. Let's try 2025 year of assessment. 2025 year of assessment. Remember, the accounting year end is June 30 every year. So, if you want to establish basis period for 2025, it will be 1st of July. That means it will end as at 30th of June 2024. If it will end as at 30th of June 2024, to make it exactly 12 months, it will start from 1st of July 2023. This is the basis period for 2024. Now, if you look at the qualifying asset, when was this asset acquired? It was acquired on 1st of September 2024. And the 1st of September doesn't fall within, 1st of September 2024 does not fall within this basis period. Because this basis period ended as at 30th of June. And you're having September. That means you will have, after September, you will have, after June, you have July, August, before you get to September 2024. So the year of assessment, the relevant year of assessment is not 2025. Now let's write 2026 year of assessment. 2026 year of assessment. The basis period for 2026 year of assessment will be 1st of July 2024, and it will end as at 30th of June 2025. This asset was acquired as of September 30, 2024. Remember, you have July 2024, August, September. That means September 2024 falls within this basis period. This asset was acquired in 2025. So you have the deposit which was made outrightly. How much is the deposit that was made outrightly? The deposit which was made on September 2024. So when you acquire an asset on hire purchase, you pay 2 million immediately. So this deposit was made outrightly. So it will, that is because it was paid in 1st of September 2024. Let me put it here. 1st of September 2024, deposit of 2 million naira. Deposit of 2 million. Then installments. Installments commenced when? initial deposits of that date. This was followed by 24 equal monthly installments of 200,000 commencing from November 30, 2024. November 30, 2024 is part of this period. Now, counts from November 30, 2024 to June 2025 to know the number of installments that will be reckoned with in this basis period. So November 2024, December 2024, January 2024, November 2024, December 2024, January 2025, February 2025, March, April, May, June. That makes 8 installments because the basis period ended June 2025. It ended June 2025. That is why we counted from November 2024 to June. The reason why we are not starting from July 2024 is that the date of the commencement of the payment of that installment is November 30, 2024. That is the date of the commencement of the payment of installments. So November, December, January, February, March, April, May, June. So it is 8 installments that falls within this basis period. So that means installment from November 30, 2024 to June 30, 2024. That is the installments that falls within this period. So the installments is how much? 8 installments. 8 times. We said the principal element is what we are going to use, the principal portion. This principal portion per installment is 150,000. So you have 8 times 150,000. So we have 8 times 150,000. That gives us 1.2 million. So if you add 1.2 million to 2 million deposit, you'll be having the total of 3.2 million. This is the qualifying capital expenditure in 2026 year of assessment. After 2026, the second year is 2027 year of assessment. You know, this basis period ended in June 2025. That means the next basis period will start from 1st of July 2025 to 30th of June 2026. That is the basis period for 2027 years of assessment. Now, the deposits have been paid and it qualifies in 2026 year of assessment. Then in 2027, no deposit will qualify. No, from July 2025 to June 2026. That is period of 12 months. Remember, 8 installments have been considered so far. Then here, since this basis period is 12 months, 8 plus 12, that will be 20 installments. Now, we have installments. Installments that fall within this period. Installments, which is 12 installments from July 2025 to June 2026. 12 installments times the cash element included in each of the installments is 150,000 times 150,000. So you have 12 times 150,000. Then you have 1.8 million. The qualifying capital expenditure in 2027 year of assessment is 1.8 million. Then after 2027, the next year of assessment is 2028. The basis period for 2028 year of assessment is first from 1st of July. This ended in June 2026. So you have 1st of July 2026 to 30th of June 2027. This is the basis period for 2028 year of assessment. But if you consider the installment you have considered so far, you've considered 8 installments in 2026, then you consider 12 installments in 2027 year of assessment, and the total installments is 24 equal monthly installments. You have 24. If 8 has been considered in 2026 and 12 have been considered in 2027, that means you are left with 4 installments. That is installment from 1st of July 2026 to July, August, September, October, to July 26, August, September, October, from July to October 2026. That is the installments to be considered here, which is 4 installments. 4 times the cash element is 150,000 as computed earlier. So we have 4 times 150,000. That gives us 600,000. The amount of installment to be considered in this year will be 600,000. So this is the apportionment of the higher purchase price or cash price. If you sum up this, 3.2 million plus 1.8 million plus 600,000 plus, if you add the 3.2 million plus 1.8 million plus 600,000, it will give you 5.6 million. The sum of these 3 is 5.6. The 5.6 million is the cash element. If you look at the question, you are given the cash element to be 5.6 million. If you sum up the cash element, the capital element together for those periods, it must be equal to the cash element. Please take note of that. Now, the next thing is to proceed in the computation of capital allowances for the relevant years of assessment. The name of the entity is Idiaraba Limited. Enter into a hire purchase agreement with Idiaraba, who acquires the asset. 10 generators were acquired on hire purchase by Idiaraba. So that means you are going to have Idiaraba Limited computation of capital allowance for 2026, 2027, and 2028 years of assessment. We have Idiaraba Limited computation of capital allowances for 2026, 2027, and 2028 years of assessment. So let me have category 3, because one qualifies in 2028, another one qualifies in 2027, then in 2026. So we have capital allowance rate. Since it is plant, it is generator, which is plant and equipment. So you have initial allowance to be 50%. Initial allowance 50%. Annual allowance 25%. So these are the rates. So let's put Naira. Now, the first year of assessment is 2026. The cost that qualifies in 2026, back to our earlier solution, 2026 year of assessment, the qualifying capital expenditure is 3.2 million. 3.2 million. 3.2 million. I will advise you watch my first 3 videos on capital allowance for better understanding. Then we have initial allowance. Initial allowance rate is 50%. Calculate 50% of 3.2 million. That gives us 1.6 million. Then the annual allowance. Let me put capital allowance for the year. Capital allowance for the year. for the year. Capital allowance for the year. So, initial allowance, we have 1.6 million. Annual allowance. So, the life of the asset, number of years of the asset will be 100 over annual allowance rate. And our annual allowance rate is 25%. 100 over 25 will give us 4 years. So, to compute your annual allowance for 2026 year of assessment, annual allowance will be cost of 3.2 million, 3.2 million minus initial allowance of 1.6 million, 1.6 million divided by the estimated useful life of the asset, which is 4 years. So 4 years. 3.2 million minus 1.6 million, that will be 1.6 million divided by 4. So we have 400,000. So the annual allowance rate for the 2026 year of assessment is 400,000. So you have 400,000. So 400,000. Remember, in the question, you have to ignore the investment allowance. So if you add the initial allowance and annual allowance, so you'll be having 2 million. That 2 million is the capital allowance for the year. Capital allowance for the year is 2 million. After 2026 year of assessment, you have 2027 year of assessment. So you have tax written down value. So 3.2 million minus 1.6 million minus 400,000. So you'll be having the tax written down value of 1.2 million. 2027, 1.8 million qualifies. So we have 1.8 million. 1.8 million. On this newly qualified asset, we are going to claim the initial allowance. Initial allowance rate. Remember, our initial allowance rate is 50%. 50% of 1.8 million. That gives us 900,000. Then annual allowance. Out of the 4 years of the life of the asset, 2026 is gone. 2026 has expired. That means 1 year has expired. The unexpired life, if you remove 1 year from 4 years, the unexpired life of the asset remains 3 years. Therefore, annual allowance on the 1.2 million, annual allowance, first, you have 1.2 million. The unexpired life is 3 years divided by 3. That gives us 400,000. 400,000, which is the same with what was obtained as annual allowance in 2026 year of assessment. You have 400,000. On the newly qualified assets, we have second. Annual allowance on the second, we have the cost of 1.8 million minus initial allowance of 900,000. 900,000 divided by, remember, since it is one category of asset, the unexpired life as at 2027 remains 3. We are not going to use 4 years since it's only one class of asset. So 1.8 minus 900,000, that will be 900,000. 900,000 divided by 3, then you have 300,000. The annual allowance on the newly qualified one is 300,000. So capital allowance 900,000 is the initial allowance. The annual allowance 400,000 plus 300,000. Then you have annual allowance. Our annual allowance is totaled 700,000. 700,000. Now, if you sum up both the initial and annual allowance, then you'll be having 1.6 million. 1.6 million. That 1.6 million is the capital allowance. Capital allowance for the year. Capital allowance for the year is 1.6 million. After 2026, then you have 2027. Then you have the tax. After 2027, you have 2028. 2028. The tax written down value of the assets as at 2028 year of assessment, 1.2 million minus 400,000. That will be 800,000. 800,000. 800,000. Then 800,000. Then for this, 1.8 million minus 900,000 minus 300,000, you have 600,000. 600,000. Then the one that qualifies in 2028, you have cost. The cost of the asset that qualifies in 2028 year of assessment is 600,000. 600,000. So we have the third class, which is 600,000. You can only claim initial allowance on that. So we have initial allowance. So our year of assessment we extend to 2029, 2026, 2027, 2028, and 2029 years of assessment. So in the newly qualified one is 600,000, which is category 3. Then you have initial allowance. Our initial allowance rate is 50%. 50% of 600,000, that will be 300,000. So 300,000 is the initial allowance. 300,000. Then annual allowance. Out of 4 years, 2026 and 2027 have expired. 2 years have expired from 4 years. The unexpired life of the asset is 3 years. It's 2 years. From 4 years, 2 years have expired. Then you are left with unexpired life of 2 years. So you have 800,000 divided by 2. That gives us 400,000 as well. 400,000. 600,000 divided by 2, that will be 300,000 as well. So for the third category of assets that newly qualifies, you have 600,000 minus 300,000, that will be 300,000. Divided by 2. Remember the unexpired life, since 2 years have expired, 2026 and 2027 have expired. Then you are left with an unexpired life of 2 years. So to compute the annual allowance for the newly qualified asset, you have 600,000 minus 300,000, that is 300,000. 300,000 divided by 2, that will be 150,000. Then let's sum up our annual allowances. 400,000 plus 300,000, that is 700,000. Plus 150,000, that is 850,000. If you add 850,000 and 300,000 together, 300 plus 850. Our annual allowances is totaled 1,150,000. Our capital allowance is total 1,150,000. That is the capital allowance for the year. Capital allowance for the year is 1,150,000. Then the 2029 year of assessment, 2029, you have the tax written down value. Tax written down value. Then the asset that qualifies here, the tax written down value of the first categories of asset, 800,000 minus 400,000, that will be 400,000. First class or first group, we have 400,000. For the second group, 600,000 minus 300,000. 600,000 minus 300,000. That will be 300,000. 300,000. For the third group, 600,000 minus 300,000. That will be 300,000. 300,000 minus 150,000. That will be 150,000. So the tax receivable value of the third group of assets is 150,000. Now, let's have the annual allowance. Since no asset qualifies in 2029 year of assessment, we only have annual allowance. There will be no initial allowance. So, now, 2026, 2027, and 2028 have expired. That means 3 years have expired out of 4 years. So, to compute the annual allowance for this, you have 400,000 divided by, the unexpired life is 1 year. 400,000 divided by 1, so the annual allowance will still be 400,000. This will be 300,000 divided by 1, 300,000. This will be 150,000 divided by 1, which is 150,000. But since if you put 150,000 here, the assets will be lost completely. In order to prevent the assets from being lost sight of, a nominal residue of 10 naira must be retained. A nominal residue of 10 naira. And you have 10 generators based on the question, 10 generators times 10 naira nominal residue. So 10 generators times 10 naira nominal residue, that will be 100 naira. So that means the nominal residue that will be retained will be 100 naira. And the annual allowance is supposed to be 150,000. 150,000 minus the nominal residue of 100, that will be 150,000 minus 100. Then you have 149,900. So the capital allowance for the year now will be 149,900. So let's sum up the annual allowances. 400 plus 300, that is 700,000 plus 149,900. It will be 849,000. 849,900. 849,900. That is the capital allowance for the year. So the tax written down value now. Tax written down value for this 400 minus 400, nay. 300 minus 300, nay. Then here 150,000 minus 149,900. So you have 100. This 100 is the nominal residue you have retained. So that is the solution to the question. Thanks for watching ACCA Academy. Don't forget to like the video. Also subscribe if you have not done so.